Welcome back, everyone. It's time again to buy a stock. If you've been following this channel, you know that we buy a stock every month.
Every single month.
We started with $400, and over the time, we've increased that a little bit because, hey,
Wait, a
people get
little?
raises.
Wait, a little? $40,000 is a little? That's a little bit, guys. I don't always drink $10 cups of coffee,
No,
but
no,
when I do it with my dividend checks.
no, we increased the $400 to what we buy every month.
Oh, okay. Okay,
So,
I'll go with that.
so we increased it to 800, and we have been able to grow that balance to $42,000. Now, I know it's not, hundreds of thousands or millions of dollars, but we've been doing this for 2 years and we've been able to take $400 and make it $42,000 in that time, which I think is pretty significant.
Now, if you're tuning in for the first time and you're looking at these numbers and they seem spectacular, please know that this portfolio started on this channel in our first videos, and you can see everything we did from then up until this point to get us to this point. So what we've done here is possible for you by simply just following along.
All right, let's take a look at the portfolio and see where we are year to date.
If you look at the portfolio itself, I want you to notice the gain and loss. Almost every single stock is making us money with the exception of 3. And when you're buying a stock every single month, it becomes difficult to find the value plays because we like beat up stocks. We like the ones that are getting run through the ringer because they did something stupid or something happened. But when your portfolio in itself shows that everything's making money, gets harder to pick things.
Right. And to expand upon that, we do like a beat up stock, but we like beat up healthy companies that are not getting their fair shake.
One that can take a punch and actually keep going.
Yep.
So in the portfolio, the most profitable stock we have is Honda Motor Corp. That is a very lightweight position in our portfolio because that was originally part of the $400 a month club. So moving down the list, the least profitable one that we have is Pfizer. Now, we wanted to add more to Pfizer this month, but because of its weight, and check our past videos on how we diversify and how we weight our stocks comparative to the portfolio itself, you'll notice that they have about 6% in the portfolio. It's about $3,000. And the most heavily weighted stocks in our portfolio have about $4,000. So we don't want to increase over that. We want to try to get everything somewhere around between $2,000 and $3,000 as the portfolio sits today. That does not mean that we will not increase that over time. We just want to make sure that if a stock like Intel makes a bad decision and that stock goes from 100% gain, or in our case, it was a 60% positive gain down to basically zero, that we don't have 80% of our portfolio or our money in that one position. We want to take advantage of the ebb and flow of the market, and by doing so, that's why we diversify the way we do. The other stock that we looked at that we couldn't quite buy because we want to buy the ones that are our least profitable positions is Devon Energy. I looked at them. They are less profitable this year than they were last year, so we decided, okay, let's wait. We're not selling the stock. We don't see any reason to add to the position until we see their finances look a little bit better.
And hey, if you're finding value in what we're talking about here and all the information that we're giving you, I mean, go ahead and like, subscribe, do all the YouTube-y things, because that really gives us engagement and helps us a lot. One thing I like to add is that periodically you should go through your portfolio and rebalance to make sure that your weights of each stock are properly proportioned and everything is looking good. This is that type of month for us.
Yeah, it can't all be meat and potatoes. You gotta have your veggies, people.
Eat your vegetables.
So bad.
So what did we do this month? If we're not buying a new stock to put into our portfolio, where we put our money? Well, one thing we got was a stock called Solventum, and that came from 3M.
We sold it.
We sold a stock.
We sold a stock. It was 102, 103% gain, I think.
Yeah.
Why did we sell it? When we bought 3M stock, we knew there was a lawsuit. We knew there was a liability. We knew there was an issue in there, but we felt that the stock was already pricing that into it. Well, as part of their settlement and reorganization efforts, they split from 3M and they created a subsidiary called Solventum, stock symbol SOLV. I say that right?
SLV.
So Solventum was a legitimate, viable company that is profitable, but when we took a look at their balance sheet, we saw that their liabilities have increased by 5 times. They quintupled. However, their operating revenue stayed exactly the same.
And their debt went from 2 billion to 10 billion.
Yeah,
which is a red flag.
That's the 5 times. So when we saw that, we said, okay, they don't pay a dividend. That doesn't necessarily, because that's a big red flag for us, dividend dudes.
Right.
So we decided, okay, if that's what's going to be, we're going to take the profit. So we sold the stock, 500 some odd dollars of profit.
530, I think.
Yep, and then we put it into two other stocks. Now, what happened to 3M stock when they divested from Solventum and their liabilities decreased as a result of that? The stock went up by almost 30%. They did cut their dividend, but if you're a high income earner and you've got dividend checks coming in, you pay taxes on those dividend checks. Sometimes it is better for a stock's principal to go up than for you to pay a bunch of dividends, or taxes on those dividends.
Yeah.
So
up until now, you don't pay taxes on unrealized gains. I know the government's trying to push something through to somehow tax that, but for now,
I don't know how they're going to do that.
I have no idea either.
I don't even know how would you, like, what if it goes the other way? What do you do then? Like, say, hey, I had a loss.
I had an unrealized loss, so give me taxes.
So we sold Solventum and we bought two stocks that existed in our portfolio, and the ones that we were looking for were the ones that were the least profitable, the ones that had the best numbers in terms of cash flow, operating revenue, liabilities, assets, all the things that we cover in all of our past videos. And normally we have a spreadsheet that we go through that shows all this number.
This is what our spreadsheet looks today.
Yeah, normally we have the spreadsheet. And
actually, if you watch the Home Depot video, I have it in there.
As it was? As it is now?
Yeah. Because I put Home Depot and Cisco in there that I was doing individual videos on, but I had it on the same one that we were looking for stock for 126. So you got a sneak preview of that, even though we didn't really use it.
We use the spreadsheet as a guide. It's not our gospel on what we pick in stocks. Typically what that's used for is if we have a bunch of controversy surrounding, okay, which stock do we buy? We use the numbers in that to help us influence our decision. In bad markets, almost everything's a good buy. In good markets, almost nothing is a good buy. So you have to find the one that's priced appropriately. That's what the spreadsheet helps us with. Now, in this case, we have 18 stocks in our portfolio. At the time, it was 19, and that becomes hard to track. So we just stuck with the positions that we already have and tried to find the good value inside of that. And we didn't need the spreadsheet for that.
So this month, we bought Johnson & Johnson and ADP. We took the Solventum 500 and put that into those, and we added our own money into it to equal it out.
That brings the total value of the positions to $42,000. In addition to that, our dividend income every month is $122 a month. It's a little bit less than it was last month, but we anticipated that. We even said that 3M is probably going to, we weren't sure if they were going to cut their dividend, but it didn't seem that stable to us. We said the same thing about Devon a long time ago, and sure enough, Devon had cut it. I think they are in a solid position now to keep increasing their dividend checks as time goes on from this point.
Okay, so why Johnson & Johnson and ADP? Because if you've been following Johnson & Johnson, you know they're settling their lawsuit on the baby powder, talcum powder, ovarian cancer stuff, which comes to $6.5 billion. But if you look at their balance sheet and their cash flow,
that's not serious at all, is it?
They've got
cancer.
They've got a lot of money.
$6 billion.
$6 billion, yeah. We don't necessarily go into companies that have lawsuits because there are implications there, but a company like Johnson & Johnson gets sued a lot. So they're used to it, and that's terrible to say.
That's great logic. Let's buy a stock that's always getting sued.
They have a process.
They have great attorneys, people.
They do. But the $6.5 billion that they're paying out isn't really going to hurt their bottom line too much because they have a lot of cash flow and cash on hand to absorb that.
And really good attorneys.
Really, really good attorneys. So all the same reasons that we use to buy the stock in the first place are the same exact reasons that we use to put more money into it. Now we're just rebalancing our portfolio.
Yeah, and J&J now is about $3,000 of the portfolio in itself, so that's pretty much near our cap. The second one that we bought was ADP. ADP tends to do pretty well during tax time and during major economic upheaval. And if you've been following the news, you know the tech sector has been getting layoffs all over the place.
And we just did a video on ADP, so after this, go ahead and hit that link and go watch it.
That'll justify some of the purchase here. We used the profits. Now that was 100%, once again, profit on solventum sale to purchase ADP. Now that ADP position is still a little bit lightweight in our portfolio, so we may be continuing to add to them based on whatever happens in the next financial reports. So I think that brings us to the whole reason why we're here, the reason why you're here. It's like, how do you look at $400 a month and get that kind of gain over such a short period of time? How do you get that passive income? That's really what this channel is about. We're here to help you, the person watching this, to earn those same things. Now, big, massive gains that you see when you look at YouTube Finance where they say huge gains, that's not the average investor. The average investor doesn't make that kind of money. So if you want these kinds of numbers, get a financial advisor, vet us out with them, and then follow along. You can buy these stocks, and over a period of time, if you notice that chart, you can make the same amount of money. It is possible, and here's proof.
Right, and you don't have to put thousands and thousands of dollars into it to get these kind of gains. You can start with whatever you have, and it will grow over time. And that's why we started this, to show you that even starting at $400 a month, we can grow that to a pretty significant gain. Our goal really isn't to show you what to buy. Our goal is to teach you what you should be looking for in a company to find those deep value stocks, to get those dividends and to get these type of gains, so that you're not just looking at us to, oh, what they buy this month, where I'm going to buy that. You can look into it and say, oh, I know what to buy because they taught me how.
One of the things we notice with YouTube and a lot of the other finance channels is there's not a lot of authenticity behind the channels. They will pump something, they'll talk about it, and then they'll run off into the sunset with 90% losses. This portfolio is a real portfolio. So you can see when we do well, you can see when we don't do well, and learn from that. If you'd like to know where we're moving next, stay tuned. We've got a bunch more stock videos coming out, and we will make another purchase in a few weeks. Thank you for watching.